The current live price for DataVault AI Inc., ticker DVLT on the Nasdaq, sits at $1.78 per share in the pre-market, reflecting a 3.26% decline from yesterday's close, a continuation of the volatility that has defined this stock's recent performance. Now, the common expectation here is simple. A high volatility, low float NASDAQ stock with a focus on artificial intelligence and blockchain is going to be a pure momentum trade, a name that rockets and crashes on retail sentiment and unconfirmed rumors. That's the surface level story. The deeper reality, the insight that actually matters, is that DataVault AI's recent movements are not just random noise. They are a direct, delayed reaction to a series of foundational corporate moves that most traders have either overlooked or simply not connected. The unexpected insight here isn't a new product announcement, but the subtle yet powerful narrative shift driven by the company's recent strategic maneuvers, including securing significant investment and converting a substantial chunk of its convertible debt, alongside a high-profile licensing agreement that suggests a clearer path to measurable revenue. This is a story of a speculative stock quietly working to build infrastructure, a fundamental contradiction to the simple meme stock label it often receives. And it's this tension between expectation and reality that frames the entire investment thesis for DataVault AI. The initial expectation for any stock trading in this price range with this level of price movement, over a 40% drop in the last 5 days, yet still showing a massive run-up over the last month, is that it's a pump-and-dump scenario. The general belief is that the narrative is far ahead of the actual business, and while that belief is certainly understandable given the historical trading patterns of such stocks, the recent corporate actions challenge that assumption directly. Let's look at the market action in detail. The stock has been under pressure following a sharp run-up that saw it soar from pennies earlier this year to over $4 at its peak, and the immediate catalyst for this recent decline, which saw shares drop nearly 9.36% on the previous trading day, appears to be the mutual agreement to terminate the stock purchase agreement with API Media Innovations. This termination, effective immediately with no material penalties, has created uncertainty. The market's expectation was likely that the acquisition would provide a clear, near-term revenue stream and expand their digital exchange footprint. And the failure of that deal has created a vacuum. This is a classic buy the rumor, sell the news scenario, even if the news is a broken deal. However, this is where the contrarian take becomes essential. The news cycle is so cluttered with volatile stock movements that key foundational business developments get buried. For instance, the company recently announced an exclusive licensing agreement with Silex Holding Company for an AI-driven biotech exchange platform. This agreement includes a non-refundable upfront license fee payable in installments and potential sales milestone payments that could reach into the billions. The market seems to have entirely overlooked the binding, revenue-generating nature of this Silex deal in favor of reacting to the API Media termination. This lack of market focus on a tangible, multi-year licensing deal in favor of focusing on a failed acquisition is the core disconnect right now. The trading volume, which has averaged over 75 million shares daily in the last 20 days and was still elevated yesterday despite the price drop, indicates massive retail interest, but also points to significant turnover, suggesting that short-term traders are dominating the price discovery process, making the stock susceptible to daily news whipsaws, positive or negative. We've seen similar dynamics in high-growth, high-volatility tech names like NVIDIA stock and Tesla stock during their early breakout phases, where the market struggled to differentiate between speculative noise and genuine underlying business growth. The pressure on DataVault AI is not merely from failed deals, it also stems from a short seller report, which the company has publicly disputed alongside high short interest. For a low-float stock, a percentage of the outstanding shares available for public trading is around 7%, a large short position creates constant downward pressure, ready to capitalize on any bad news. However, this same high short interest, combined with elevated trading volume, sets the stage for massive price swings in the opposite direction, should any positive news emerge and force those shorts to cover their positions quickly. This volatility is a structural feature of the stock, not just a momentary blip. The recent insider activity shows a mixed picture, with more sells than purchases over the last 6 months, which naturally raises eyebrows and fuels the bearish narrative. Yet institutional ownership, while small, at under 3% of shares outstanding, is actually showing signs of recent minor accumulation, with more institutions adding shares than completely selling out in the most recent reported quarter. This is typical of early-stage speculative growth stocks where institutions dip their toes in, often through smaller platforms like interactive brokers' trading accounts or through fractional share programs offered by firms like Robinhood Stock Trading, before committing a major position. These small institutional additions suggest that some professional investors see past the daily noise and are building positions based on the longer-term intellectual property and licensing potential. In terms of the core business, DataVault AI operates a data sciences technology platform focused on AI-driven data experiences, valuation, and monetization across multiple industries like biotech, finance, and healthcare. Essentially, the company is trying to build the infrastructure for a future where data, intellectual property, and real-world assets are tokenized, valued with their proprietary data value and data score technologies, and securely exchanged. Their information data exchange platform is key here, aiming to enable digital twins and compliant licensing of assets. This complex business model is exactly why the market struggles to value it, especially when compared to straightforward consumer plays like Apple stock or established software providers. Past financial performance shows the struggle: low annual revenues in the low single-digit millions and consistent significant net losses, which is common for hyper-growth-focused tech infrastructure firms, but a red flag for traditional value investors. The fact that their revenue guidance for the fourth quarter of 2025 is $12 to $15 million, a massive sequential jump, is the critical expectation setter right now. Achieving this guidance would be the ultimate reality check that overrides all prior concerns about failed acquisitions and short reports. A significant and overlooked component of the reality check is the non-financial partnership commitments they've secured. The in-kind commitment of 20,000 engineer and architect hours from IBM, a major global technology force, is functionally a multi-million-dollar endorsement and resource injection. This type of high-level technical commitment from a behemoth like IBM lends a credibility that a small-cap press release simply cannot achieve on its own. It directly addresses the primary risk of an early-stage company: the ability to scale and execute technically. This is a point that any investor, whether they use a full-service platform like Fidelity Investments or prefer the control of an individual brokerage account, needs to consider carefully. Technical validation from a global leader is a strong mitigating factor against purely speculative concerns. Furthermore, DataVault AI's recent moves to establish a presence in the regulated Swiss financial market through a partnership with Max International AG to launch a Swiss digital real-world asset exchange, and their partnership with Wellgistics Health to integrate a blockchain-enabled tracking system for prescription drugs, show a strategic focus on regulatory compliance and trillion-dollar markets. They aren't just selling software, they are attempting to build the plumbing for highly regulated industries. This is a deliberate effort to pivot the narrative from a speculative tech stock to a licensed infrastructure provider, which could command a much higher valuation multiple if successful. The future outlook for DataVault AI hinges on execution against that aggressive fourth-quarter revenue guidance and the successful conversion of its recent major deals into verifiable, scalable revenue streams. The primary catalyst for a significant upside move would be an earnings report that meets or exceeds the $12 to $15 million guidance, alongside positive updates on the Silex license and the Swiss Exchange initiative. Success here could trigger a massive short squeeze due to the high short interest, launching the stock back towards previous highs and maybe even towards the $7.14 average price target set by analysts. A secondary but potent catalyst is the continued integration of their patented technologies, like audio, into commercial products, such as their collaboration with NFHITS for a blockchain-based music and content distribution network. These smaller ongoing deals provide proof points for the